Good morning. Welcome to Investment Services webinar series, Retirement Within Reach. It's great to see you all joining us today. We will begin momentarily. Wendy Diacano, one of our 3 Community Choice Investment Service Wealth Advisors, will be presenting today. The Wealth Advisors have assigned locations within 21 member centers, so depending on where you're located, we have a wealth advisor who can meet you at your member center. They are available for phone consultations, Zoom meetings, in person, and by appointment only. During today's presentation, we are unable to answer questions. Retirement situations are different for each individual. Please jot down notes and questions, then use the contact information at the end of the presentation. We will have a wealth advisor closest to your member center contact you with your questions. Without further delay, I would like to introduce Wendy Diacano, our presentation speaker for Retirement Within Reach.
Thank you, Bev. Good morning, everybody. Welcome to our educational webinar series. Today, we are going to hopefully give you a roadmap to bring you to your perfect retirement plan. I am Wendy Diacano, and I am here with my 2 colleagues, Shane Robinson and EJ Purdy. I'm going to actually shut off my camera during the presentation because I do want you to take copious notes and I do want you to write down questions. And one of us will definitely reach back out to you. Thank you. So retirement means so many different things to so many people. For some reason, or for some, it's like freedom of having the time with loved ones, or having the financial freedom to explore the world, which would be me, or to pursue new hobbies and interests. Others plan on donating their time to giving back to the community through volunteerism, which would also be me. But basically, folks, in reality, retirement is roughly 1/3 of our lives where we're not going to get a regular paycheck. So, for example, if you're 67, you're probably going to spend at least 20 years or more in retirement. Just remember, the money you put aside now during your working years has to last as long as your retirement does. So let's examine some of the common obstacles that people must overcome when thinking about retirement planning. I mean, what really gets in the way? Part of the problem is inertia, just plain getting started. According to a recent survey, half of Americans are not prepared to retire. In fact, over half have not even tried to calculate how much they're going to actually need to live comfortably in retirement. 33% of our society don't even have the confidence in their ability to choose the right investments. That's where Shane, EJ, and I come in. As humans, we either get overwhelmed or simply have a lack of understanding when it comes to financial planning and personal financial issues. So when you combine inertia with the limited understanding of finance, it's not surprising that some people feel behind the 8 ball. Plus, there are a lot more pressing immediate needs for our money. It's called life. But there are a host of reasons to begin thinking about retirement now. I mean, we're living longer, changing responsibility for retirement planning. There's inflation risk, importance of starting now and keeping at it, Social Security, medical expenses. That's a big one. You certainly hope that in retirement, just as in your working years, your income is more than the total of your expenses. I mean, that is the ideal result, right? Simply put, you just need to live within your means. If you are fortunate enough to have excess income each month, think about putting that money to work by investing it. But it's entirely possible that your expenses might be greater than your income. And if that's your result, you're going to have to look harder at places to cut. Examine ways to increase your income, or maybe even consider working longer, which I realize isn't ideal in most cases. Or possibly postpone your retirement. Of the various sources of income, Social Security is currently projected to account for approximately 37% on average. The rest does come from retirement income, or a combination thereof of our savings, retirement, pension assets, what have you. It's important to start thinking now about how much you'll need to live, comfortably speaking, in retirement. And don't forget to factor in inflation to protect your buying power each year. Here is a brief perspective on the rising cost of living over time. Inflation is basically the rate at which the general level of prices for goods and services is rising and the purchasing power is falling. In retirement, you will probably be living on a fixed income. However, the cost of basic essentials will likely continue to rise. This loss of a dollar's buying power over time can have an adverse effect on the real growth of your retirement account. So be sure to maintain a proper mix of investments in an effort to offset inflation. Working with a financial professional goes a long way towards making sure that you're invested in the right areas. Now, you can receive Social Security benefits while you're working. There is, however, a limit to the amount that you can earn before your benefit is reduced. For 2021, that limit is $18,960. Good news is it is adjusted annually to reflect inflation, but this limit applies only up to full retirement age when it goes away entirely. So let's look at an example. Assume a person is age 62. They're receiving benefits, they have a full retirement age of 66, and they earned $19,320 for the year. Well, his or her annual benefit would be reduced by $1 for every $2 that his or her earnings went over the limit. In this example, the earnings were $360 over the limit. Obviously, the earnings limit is a key factor to consider between age 62 and your full retirement age, but there is good news. The earnings limit no longer applies at full retirement age. There's a lot to think about regarding Social Security, guys. I'm sure you agree that this topic needs to be at the top of your list. I always urge my clients to either visit their local Social Security office or go online to see your illustration, which shows you how much you will earn at the different various ages. It's such an easy to use calculator to estimate your benefits. I go onto the site probably 2 or 3 times a year to check out my own calculations. Now, the next big one, you will also need to plan for medical expenses. This is the one that actually stressed me out at a very early age. Now, there are ways to save for your healthcare expenses down the road. So my plan, at least I thought it was a great plan at the time, and it actually turned out to be a wonderful plan. Since I was 23, I started adding to a non-retirement investment account. So I basically just dollar cost averaged money into an account every single month. I've been doing it for, I'm not going to tell you my age, but for a very long time. So now I have amassed a bucket of money that I have earmarked just for my medical health care expenses, or basically health insurance, right, when I retire. A recent study from Fidelity projects that it's going to cost a 65-year-old couple approximately $295,000 to pay for medical costs throughout retirement, and this excludes the cost of nursing home or other live-in care. Medical costs and inflation can quickly erode our retirement savings. So the key to preparing for retirement is to start early. Start early, and save regularly. These behaviors are not always easy. Our views of saving and investing are shaped by powerful forces, not always within our control. I mean, there's many factors that influence our views of money, and emotions can play a very significant role. Research studies show that emotionally driven investor behavior has a bigger impact actually on success than the market's actual performance. The key for investors is to separate the events in their lives from how they feel about their financial situation. So for example, investor sentiment tends to be increasingly positive, leading up to a peak of exuberance, and then progressively negative on the way down to a trough of despair. Rinse and repeat. Curiously, many investors tend to feel the happiest when they're seeing the market at their highest peril, and the most despondent when the potential upside is the greatest. I know, it's counterintuitive. But there are additional personal factors that may influence our investing decisions: age, gender, and a herd mentality. Investor reaction to 2 of the worst bear markets for stocks since the Great Depression is partly explained by age. As the surveys revealed, even within specified age groups, Willingness to take investment risk has dropped markedly since the late 1900s and early 2000s. I mean, let's face it, we've experienced some real market swings in the last 20 plus years. And as for gender, numerous studies have looked at the way that men and women approach investing, and there are distinct differences. Women are much more likely to research a topic, ask a lot of questions, really before making any decision. Men are more likely to conduct research on a gut instinct level. And it can be men also do the research and women go with their gut, but this is just according to some recent studies. Now, for the herd mentality, most investors believe that there's safety in numbers by moving in the same direction as other investors. This is the herd mentality. It generally leads to poor investment results, as crowds tend to sell their stocks when they're at a low and they buy them at a high. I mean, I can't tell you, this last spring, right when COVID hit and the markets took that 35 plus negative turn, and I had maybe a handful of clients that just really got frustrated and scared and said, put me to cash. I reached back out to them like late spring, I'm going to say, and they still were not ready to get back in the market. I only have a couple that just never did, and they're still sitting in cash. Well, the markets have turned around significantly from then. So I'm constantly telling clients that we need to stay in the market in order to see the long-term positive results. So, but I get it. In the case of extreme volatility, investors will move in sync. They want to get away from risk and they want to move towards safety. So when they perceive that it's safe to get back into the market, investors get back in together, bidding up the asset classes, which is also kind of known as a collective irrationality of investors. You're buying high. Now, the media focus is another factor. I have to tell you, this is one of my, what would you say, banes of my existence. In the past decade, I've seen the markets move more off of a new soundbite than ever in my 20 plus years as a financial planner. The true technicals seem to be completely lost. I mean, it's true that news headlines shape our opinions, but the last 20 plus years have been especially volatile period in investing. And there's a lot of news to fan the flames. I mean, Enron collapsed. Big banks got those huge bailouts. Bernie Madoff, the subprime lending crisis. And those are just a few of the stories that the media picked up and ran with it, waving a doomsday flag. But investors should remember that newspapers and TV reporters have agendas of their own. It is different from you as an investor. Frankly, they need to sell newspapers and television advertising. And like it or not, people buy papers to read the bad news, not the good reports. So guys, we got to take action. We've got to turn our attention now to getting busy. If you're not always enrolled, if you're not already enrolled in your employer retirement plan, do so today. Well, as soon as I'm done. If your employer doesn't offer a plan, there are ways to save in your personal IRAs. Feel free and reach out to us and we can explore those options. Now, most retirement plans that are offered today are defined contribution plans that are under the Section 401k of the Internal Revenue Code, or 403bs. The key features include a savings account built especially for retirement, authorized by the IRS, of course, but it allows us to set aside up to $19,500 in 2021, pre-tax, in an account that you own and you can take with you when you retire or change jobs. It offers special catch-up provisions for those 50 and older, up to $6,500 per year right now. So if you're 50 plus, you can actually put $26,000 away. I realize that's a large dollar, but for some lucky individuals, they do take, advantage of that. And these limits don't increase every year, but they do adjust from time to time with inflation. Qualified retirement plans offer the following benefits. So one of the biggest bangs for our buck is tax deferred growth potential, because we're not actually having to pay taxes every single year as our money grows. Also, automatic payroll deduction, huge. keeps us all honest. It keeps us always putting our money in, and we're not having to call our financial advisor and say, hey, did I add money last year to my retirement plan? Professional money management. So typically with every employer, you're going to have a 401k or a 403b that's offered through some investment firm. Well, with that investment firm usually comes an investment professional who oversees the entire plan, and you usually can reach out to him or her for advice, but Shane, EJ, and I are here as well to help. So the opportunity to invest in ready-made portfolios, it takes a legwork out of you guys having to figure out how and what to invest in. And there's a range of educational resources and one-on-one contact with us, the wealth advisors here with Community Choice. So on this slide, I just want to show you the most powerful tax advantage of contributing to your retirement plan: employee elective deferrals. Contributions to a tax-deferred savings plan may be deducted from your paycheck before income taxes are considered. Now, pre-tax contributions, as opposed to after-tax contributions, may actually reduce the amount of household taxes that are paid each year. To encourage your retirement savings, the government does allow you to make pre-tax contributions to the traditional 401k and 403b plans. Now, the Roth 401k, that would be an after-tax contribution. That's a different situation. But the advantage may increase the amount of money that you take home after taxes. So hypothetical, let's look at an individual who earns $30,000 a year. They contribute 6% or $1,800 of his or her pre-tax wages annually to their 401k or 403b at work. And another individual making the same salary makes no contribution. Note, the tax-deferred investor took home a little more of his wages and saved $450 in current taxes. Now, this chart is based off of a 25% tax bracket, and it is for illustrative purposes only. Now, to decide how much to invest in your account each month, it helps to have a financial goal in mind. Lifestyle plays an important role. If you plan to travel when you retire, which is my plan, you're likely going to need a bigger nest egg than if you plan to putter around in the garden. It's important to look at your current financial situation with your eyes wide open. If you are paying off high interest credit card debt, you may want to put off investing or looking at increasing your retirement contributions until you get that debt down to a manageable size. You may have other sources of income at your disposal when you retire that will lessen the need for contributing to your plan. Half of the baby boomers actually expect to receive an inheritance over their lifetimes, according to a 2019 statistic by Bloomberg magazine. But don't just buy that RV yet, because the median boomer inheritance will be around $55,000, but that's not even guaranteed because the majority of heirs will get smaller amounts. Bottom line, don't assume an inheritance eliminates your need to increase your savings. And finally, life expectancy is so important, guys. We have to be aware of it. I had a client who lived to 104 years old. So if you have longevity in your family, you're probably going to want to save more aggressively for a retirement plan because your retirement could last 30, 40 years. Now, most financial experts suggest that you need 75 to 90% of your current annual income to live comfortably in your retirement. So let's look at how much will Social Security contribute. So for the average person, Social Security may replace about 30 up to 40% of the wages that a working person earned before their retirement. But like I stated earlier, make sure to visit the Social Security website and use the interactive retirement calculators. They will give you a rough estimate of what you can expect in Social Security benefits at certain ages. Now, assuming your 401k and 403b account is already well diversified, meaning it holds a mix of stocks and bonds and cash, well, roughly 92% of the variation in your investment return will come from the way you've divided up those asset classes. That's just what we refer to as asset allocation. Asset allocation is a technique of dividing your investments across a broad range of assets, and it always includes the stocks, bonds, and cash. Some investors like to do this themselves, and others prefer to have it done for them. It's really up to you. The more you learn about the markets, the more you may want to pick and choose where your portfolio holdings go, and the more satisfaction you may get out of the process. That was me. That's why I got into the business. Working with a financial planner or using a managed solution may be a good approach as well if you have little time or really no inclination to manage your investment portfolio on your own. So in a 401k and 403b lineup, you may see something like a target date fund. Those are actually actively managed based off the time frame where you think you're going to be retiring. Example, a 2035 fund would be appropriate if you think you're going to be retiring around the year 2035 or later. So when making all of your investment selections, make sure you keep in mind all of the following. Your attitude toward risk. This is a big one. The amount of risk you can handle to get the returns you need. If you're younger, you may stomach more risk as opposed to you being 5 years out from retirement. Your time horizon. How long until you're actually going to need to start taking money out of your retirement plan? Your investment goal. Well, how much money do you really want in retirement? I mean, I know you want to pursue the lifestyle of your dream in retirement. So let's take a look at the primary mix of assets that we invest in within these retirement plans. There are 3 basic asset classes: stocks, bonds, and money market instruments. I'm not going to get into all the different types of investments that are really out there, because in 403b and 401k accounts, they really focus on stocks, bonds, and money market instruments, and they package them in something called a mutual fund. Stocks generally have the highest return potential, but also higher than average risk because it's representing a share of ownership in a corporation. Bonds have generally conservative returns, but typically carry much less risk than stocks, because an investor loans money to a company or a government, which then pays that investor principal and interest on that loan. And we all know what money market instruments are. They have the lowest risk, but also the lowest return potential. So they're basically like a high yield savings account. But however, savers have been punished for at least the past 14 years since rates have been in a historically low environment. Now, these next statistics are meant to familiarize you with how investments have performed in the past. I mean, no one can predict what will happen in the future. But first, let's talk stocks. Now, and this actually is from a 20-year period ending at the end of December in 2019. The S&P 500, which is the most widely watched index, has outperformed every other type of investment, returning an annualized average of 7.68%. So if you were in the S&P 500 index for 20 years, you actually every single year earned 7.68%. Yes, stocks carry higher risk, but they have also been proven to give higher returns over long periods of time. So now let's look at bonds. Now, bonds have produced an annualized return of just over 5% over that same 20-year period, but they carry a lower risk of price fluctuation. So money market, again, it's the safest option, but it typically isn't wise to keep all of your money in a savings account while building your nest egg. So on this next slide, we present 7 sample asset allocation models that you might find useful when setting your own goals. So each pie chart represents a certain level of risk tolerance, from low risk, ultra conservative, to ultra aggressive risk. Under each chart, it lists 5 asset classes and the suggested percentages of cash to allocate to those asset classes to meet your basic goal. So remember, asset allocation does not prevent losses or guarantee a profit, but it is a way to potentially reduce your risk of experiencing severe losses by being too heavily concentrated in a single asset class, say small cap stocks. Now, rebalancing keeps your plan from getting out of whack by having too much in bonds or too much in stocks. Rebalancing is just basically adjusting your mix of stocks and bonds and cash to an original target. My clients come to me all the time and say, okay, Wendy, am I still on track? If one of your asset classes has done well in the past year, you may want to sell some to bring your portfolio back to balance. So here's an example. You want to own 60% of your portfolio in stocks and 40% in bonds, but a stock market rally increased your percentages to over 70% stocks and just under 30% in bonds. Well, you want to rebalance by selling some of your stocks and buying more bonds to get you back to that true balanced approach of 60-40. Many financial experts believe that rebalancing once a year is sufficient for typical investors. Rebalancing does not guarantee a profit or protect against losses in a declining market. But the next step, it's really up to you. If you haven't already, I urge you to create an investment plan that takes into account your goals, your time horizon, your risk tolerance. Keep in mind that an early start can make a huge difference in reaching your goal. Consider this chart, which I actually really find fascinating, but it is true. Investor A, who began investing at the age of 25 and invested for just 10 years, came out ahead of Investor B, who invested for 30 years. Their accounts earned the same rate of return, 8%, but Investor B contributed 3 times as much and ended up with a smaller balance. I'm telling you, start early. Again, please keep in mind that these examples are hypothetical. Investment returns cannot be guaranteed. Now, once you've set up your retirement account, it's important to monitor your progress. Lots of companies have gone paperless, so it's important to work with your human resources or your benefits department so you know how to access your account online. If you still get a paper statement, those typically get mailed out every 3 months. And if you don't see something quarterly, they may only send them annually. So for most people, looking at your statements or accessing your account online, like I do each quarter, and rebalancing your asset allocation back to your target may be all that you need to do. Now, of course, if you have a major life event that affects your ability to make contributions, you may want to wish to make adjustments to your retirement plan and strategy. So in summation, since investor behavior is considered by many to be more important than the returns of the individual stocks or bonds, remember to increase your contributions whenever you can. Starting early and investing regularly are 2 proven ways to put that retirement within reach. Now, today I've shown you the importance of saving for your retirement and how a retirement savings plan can help you reach your financial goals. Now, if you have questions, please email us at info@ccisinvest.com. And we will connect you with the wealth advisor in your area. Or you can even call 877-243-2528, extension 1330, and our wonderful administrative assistant, Beverly Humphrey, will get you in contact with one of us. Now, here are some useful sites that I suggest everyone checks out. If you don't want to write it down, please reach out to us at that info@ccisinvest.com email, and we will send you an email of all of these sites. Now, I just want to thank everyone for their time today. Please write down our contact information. And like I said, the easiest way to reach us would be to reach out to Beverly, and her contact information is on the screen. So I just want to say happy spring to everybody and enjoy this beautiful day, or should I say summer-like week that we're having. Thanks, guys.